Hello and welcome to Trading with Technical Indicators. My name is James Boyd. We welcome you here today. We got Michael Fairborn, my good friend, in the chat. And yeah, give him a tough time. He deserves it. And any question that you have, I know that he can answer it. Hello, Grace, Rick, Silas, Scott, Wiley. Yeah, no red shirt. Unless it's the Huskers or the Buckeyes, I'm not wearing a red shirt. So it's just not going to happen. I think I'm going to give that one to the local store. No red shirt. It's going on strike. Okay. And we welcome all of you here today. Now, today, Trading with Technical Indicators, we'll follow through on that conversation we had from last week and kind of talk about where the markets are. So let's kind of hop right in. Now, remember, when we talk about trading with technical indicators, it's not trading with your feelings. Okay. It's trading with what we're seeing on some of the indicators like moving averages, MACD, stochastics, and so on. We'll also talk about and highlight kind of picking a strategy, which is very important when you have a market that's actually pushed down like it has. Now, remember, as we get started, the information here is provided for general informational purposes only, should not be considered an individualized recommendation. When we talk about examples, they are just that, and we will do those in the paper money account. That paper money account will be done for educational purposes only. When we bring up, or if we bring up options, we'll talk about stocks as well. Remember that options carry a high level of risk, not suitable for all investors. When we talk about also investing, we need to understand that investing involves risk. So the investor is taking a risk to try to make something. It's not a free lunch here, okay? And we're talking about stocks or we're talking about options. So this is not like a fixed income product like a treasury bill and something like that where, it's in full faith of the U.S. government. We're not talking about that. These are stocks. They could go up or down in value. Now, also remember when we talk about our agenda here, I want to talk about kind of where the market is, follow through on that, what we discussed last week on the stochastics. I want to talk about where it is in terms of the stochastics, markets and sectors, and then I want to talk about some stocks. And with that stock discussion, I want to kind of talk about strategy selection, okay, and kind of setting things up for the week. Now, just real quick, as we get started, I want to just pull up just briefly, just recognize that this is being recorded. So you could go right to this page. Okay, let me send this out to you. So if you go to our YouTube page, what's kind of nice about this, you do not have to be sitting on your computer to watch this. You could be anywhere in the world, literally, okay, if you had an internet connection. So the biggest actually thing is you can go to this page. If you have not subscribed already, click on subscribe. Now, when you do that, there's also with every class, we have a playlist. So if you say, hey, James, I have some favorite classes, hello, Faz to you, and happy Canadian dollar for you. Now, the biggest thing is this class has a playlist, okay? And on the playlist, you can see previous episodes of what we discussed. Last week, we talked about how to read a stochastic indicator. The previous week before that, candle tool to see trend types. So we're going to kind of follow through on those ideas that we talked about in the last 2 weeks. Now, let's go ahead and just pull up just briefly. And by the way, I want to kind of make sure that you kind of see a process of what we're talking about, lists that we use. If you have questions on why do we use those, let us know. So first off, we just woke up. I'm not saying we did, but if we just woke up and we saw the VIX, they're at 26.94, well, that would tell you something. So for every 16 on the VIX, so if the VIX was at 16, the expectation is the S&P would fluctuate up or down, okay, in total, 1%, okay? So if the VIX is at 16, the S&P range of movement percentage-wise is about 1%. If we were at 32 on the VIX, how much would that be? Well, it's probably going to be about 2%. So we're a little bit more than halfway there to that 32 figure. So on a daily basis, the expectation is the S&P would probably fluctuate percentage-wise, probably about 1.5%, okay? So the higher up that VIX number goes, the greater the fluctuation in percentage on the S&P 500. Now, the other one that we do not like to see, boo, is that second row there, which we've been talking about, which Thea has been all over. We call that, well, it's not, we call that, it's called the Japanese yen, and that's kind of showing more international fear, spiking a little bit, and it's that breakout is continuing. So here's the point. When you see VIX up and you see yen up like that, that probably tells us that many stocks, indexes, sectors are going down without even probably looking at them. We would probably say really good chance, okay? Now, when you look on a percentage basis, Russell down 2%, S&P down 2.45, more than what we thought, NASDAQ down 3.6, and the semiconductors down 4.56. That's the industry group of semiconductors. Now, notice that the NASDAQ, we're talking about the index, okay, down 3.6%. I want to kind of start with this first on the NASDAQ. Now, remember, when we think of NASDAQ, we're talking about 50% weighting to tech stocks, okay? Think of those tech stocks as growth stocks. Now, if they do reach what the expectation was, it could be amazing. If the expectation of what they could make is becoming more and more and more cloudy, investors could exit the area aggressively. Boy, have they. Now, when we look at on the Market Watch tab, feel free to set yours up on the same way so we can be on the same page. Market Watch. And when I look at this on a weekly basis, percent-wise, NASDAQ is down 7% for the week, okay? Russell down 6, Dow down 3.91. Geez, that one feels a lot less. And what you're going to notice, the S&P is down 5.7. Now, double-digit losses for the month coming from NASDAQ and also the Russell, okay? Now, the one thing I want us to kind of watch, and this is where we kind of, as bullish investors, and how many of you are bullish? How many of you like to be bullish? How many of you just say, James, even if the market goes down, I just like to be a buyer? So when I say that you're a buyer, let's just say that we're mainly long-only investors. Long-only means that we buy stuff, whether it's the index or product that tracks the index, the sector, the industry group, the stock, whatever it is, we just buy stuff, okay? Now, most people are, okay? Most people, that's what they do, okay? And what you're going to notice in this type of market, we're just kind of seeing less things to potentially get into if you're waiting for signals or indicators. When we look at the moving averages, what you're going to notice is they're still red, okay? So when we look at that, it's telling us red stop sign. Now, I'm going to tell you the hardest thing for me, and let me know if you're in the same boat. Have you ever been in an intersection? You're walking on the sidewalk, and it's pretty much you look across the street and it says, don't walk in red. And nobody's coming, or you just want to go. Well, as a person, what do you tend to want to do? You tend to just want to go. The indicators right now are kind of telling us red sign, stop sign, okay? It's really saying that bears are in control. And that selling pressure, we're below the shorter term moving averages, which is not a great sign because you have negative momentum. If there was any indication that we were starting to see a bounce, the 10-period moving average should be able to catch it. What do we see? Answer, rejection, okay? Now, when we look at the 20-period moving average, looking at the trend, all red. So trend right now on a short to intermediate basis down as well. And if we look at, let's say, are there any flags or anything like that? Yes, there are. And when we actually look at, let's say, the breakouts, these are breakdowns. Okay, those are breakdowns. Now, one thing I want to kind of make sure is let's take a look at these charts before we look at examples. But based on what we're seeing with the indexes, what pockets of the market do you think people would tend to go to? Do they tend to just grab the falling knife in the NASDAQ area? Do they tend to grab the falling knife in discretionaries? Okay, little danger zone. If we go to the sectors just real quick, and kind of said, where are they going? Okay, it wouldn't shock us that a lot of investors would say growth is risky. It always is, okay, especially when it's falling. Now, the one thing I want to kind of look at here is when we look at the sectors, briefly before we look at the charts, when we look at the sectors, staples eked out a gain, healthcare eked out a gain, utilities down a little bit, real estate down 1.9%, okay? Monthly returns, almost all positive on those top four. But when you go look kind of down on the list, it's discretionaries down the worst. And boy, Tesla has been ugly, hasn't it? Whoa, okay. And what you're going to notice is technology, that hasn't been obviously matches what we just talked about, okay? So kind of everyone's, well, not everyone, but some investors kind of trying to hide in these top four rows right there. Now, I think the one area that we need to at least mention, as Fayez just touched about, is healthcare, okay? Right there. And that's the one that's kind of been doing quite decent, okay? Now let's kind of talk about strategies. This is very important, okay? You can talk about indicators all you want. But in a backdrop like this, when we pull up these charts and say, okay, here's the SPX, what strategy might the investor consider in the current market? I'd be interested to know your thoughts on that. So remember last week when we talked about the divergence, right? And the question we have now is that divergence still happening? Remember, we wanted to see the price going down, which it has been, and it still is. Today's a fresh new low. And if you look at this on the MACD, we're looking at the lowest red bar, and then the next lowest red bar, and I'm not talking about burgundy, the next lowest red bar, we wanted that line to kind of go like this. Now today, so far, and that's the key word, so far, that MACD going down lower than what we wanted if we were showing a divergence. Now last week, we talked about the stochastics, and we looked at some two main settings on the stochastics, and we said, look, first off, when we had got down to these oversold areas before, like here, the oversold price action did not last very long. Can anyone tell me what's a little unusual about this compared to prior levels? How do you interpret that? So let's compare 1, 2, 3. How is 3 different than 2 and 1? How's it different? How do you read that? Good thing or bad thing? Does that tell us anything about trend, sentiment, right? So if you go down and you have an oversold reading on the stochastics, and you're not getting the trend. Now remember, if you look at the moving average, the 20-period moving average, it has been on fire, okay? There hasn't been anything close to green yet on the moving average. Red, 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 telling us stay away, okay? When you take a look at this, the fact that we're oversold and we're not getting any buyers to step in kind of tells us the momentum is even probably worse than we think. I have no joy in saying that. None. The other thing is we probably say, well, there's a long-term trend. Well, you could always say that if you compare it back to the 1900s, okay? But when you look at this, we probably say this intermediate trend that we're in kind of worsifying, if you will, okay? So the longer you stay in oversold without getting buyers to step in and cause the moving averages to change, price to get above that, either the moving averages or both, the longer it takes, the worse the trend is being. Now, James, that's a lot of negative all at once. I can't take that, okay? So let me give you a positive, okay? Canary in the coal mine. Now, if you've ever done bearish positions, you'll know that you can go out there and buy puts. And the one thing we know about puts is the higher that the VIX goes, the more expensive that they are, and you have to have a bigger price movement to get to break even. So when you kind of think about bears here, if they think the market is going to fall further, you got to get a bigger move. So the question really becomes is, does the bears have a greater probability of winning? We'd probably push back on that and say, no, the higher that the VIX goes, they have a lesser chance of winning because it's a bigger premium if they buy those puts. Whereas the bullish investor might have greater odds of mean reversion, okay, on the volatility. So this kind of goes back to why some investors like to be long. Now, and when I mean long, I'm talking about that they're buying things. Now, the problem is sometimes what we like to buy might not necessarily always have a trend. So if you say, I like to buy technology, I like to buy discretionaries and so on, I like to buy energy stocks or financials, sometimes you just don't get those type of trends in those areas. Sometimes that little saying that says, take what the market gives you, sometimes you kind of have to take what the market gives you. Where are those trends? Not saying that you're going to be in there for the next 5 years, but you're just trying to say, where are the current trends? Now, Dave, okay, Dave's going old school now. Now, so if you remember what was it, the 08 bottom, I think the Dow Jones index went to 666, okay, and it stopped right on 666. Dave is pointing out 666 on the Dow. Dave, maybe you're thinking about that 08 bottom. Okay, yes, I was there, for crying out loud. I saw every bit of it. Now, some of us liked it, okay? So the fact is, we kind of have to control the emotion, which is the indicators are telling us sellers are firmly still in control. The second thing we want to kind of be thinking about is, hey, look, the higher the VIX goes, does the investor just put their head in the sand? Not necessarily, okay? But the biggest thing when we ask the question about strategy, still having defined risk strategies. Like what? Well, buying the stock with the put together. Now, let's kind of talk about where is the market kind of still giving some trends. Now, I want to kind of talk about just real quick a couple stocks. We talked about Mickey D's last week. I'm not sure. I just want to kind of point this out. Mickey D's was one that was making, I'm going to call it a cup, okay? I'm not going to say it's the best cup we've ever seen in our life, but I had that idea, right? Most of the bottom was at 289, rallied up, pulled back, and on the right-hand side, it kind of had some higher lows on the right-hand side, also making like an ascending triangle. It broke to the upside, okay? Now, my point in bringing this up is when you have volatility, you have to understand that you have greater price swings, and the investor might try to be very picky on where they try to get in. Now, last week we bought the shares of stock, okay? And what I'm going to do is I'm going to try to add to the position. Now, I think this is also very important. When we kind of have volatility, go back and look at the 3-year weekly trend. Okay, so if we look at the three-year weekly trend, it's not something we're just seeing on the on the daily chart. But if you take a look at this on the weekly chart, we still see it's bullish as well. So what I'm going to do is I'm going to try to add to this position. Okay. Now remember, we're going to call this the upper shadow Lisa Jack candlestick. Lisa loves these. Okay. Little rally to the upside, fade off the high. It could have been some people from Chicago selling. I have no clue. I'm just saying Chicago because, there it is, home headquarters of Mickey D. Now, what I'm going to do is I'm going to put that an entry right at the middle of the candle. So remember, when you have more volatility in the market, try to be a little pickier where you're trying to get in, okay? Now, what I'm going to do is I'm going to right-click on this chart, okay, buy custom, and I'm going to go down to with stop or with the OCL bracket. Let's go bracket, okay? Now, when we do this, what I'm going to do is I'm going to go back to how many shares we could do. And I want to just put that right in that paper money account. If you don't mind, let me bring that back up. There we go. And we put it right there. So where's the middle? The middle of that green candle is really right about buy custom with OCL bracket. The middle of the candle is at 316.44. Okay. Now, if we look at that 316.44 and we go back to the position size, and this is very important. Okay. Remember I said the first thing is when markets pull back, if you over position size, the market exposed you. And James, have you ever done that? Oh, of course. Have you ever done it more than once? Absolutely. Have you ever done it more than 3 times? Absolutely. Redheads? Okay. Hey, a little tough. Okay. I'm just saying there's a melon here, but there's some wood too, where just sometimes it takes me a little longer to remember. I don't learn from successes. I learn from failures and getting burnt. Okay. And so now after time, I can tell you have a better chance of not doing it. Okay. If you burn yourself on position sizing. Now, what I'm going to do is I'm going to go back to that 3,500. We did 6,500 the first time. The second time, we're taking a half position. And that's the problem. We're so tough. But this is not a tough man or tough woman game. Okay. This is not to see how tough you are. That's not the point. I don't know why I thought that. Now, what I'm going to do is this is a half position. Now, why a half position? Well, you got to remember something. In a market that's more volatile, a half position will probably feel like a full position. I mean, think about that. If the market's moving twice as much on an average daily basis, a half position probably feels like it's almost like a full position. So when you kind of see choppier market conditions, imagine you're driving, you're out on the lake and it's choppy water. Do you go as fast when it's just glass out there, the no waves? No, probably not. You cut the speed. Well, in the market, well, what the investor could do is just cut the position size. Okay? Chop the amount of capital down. Okay? Now, what I'm going to do is, there's the shares, 316.44, dated GTC. So the stock in this case, we need that stock to come to that price or less. 2, I need a target. Tell me where the target is. Okay? And I'm going to come down here to the stop. Now, here's the bad thing about investing when volatility is going up. We know one of the risks is when the volatility is going up, things are moving around more, which just means that there's a greater chance of us getting stopped out. So why do even people put a stop? Well, to try to have an exit to protect capital. The bad part about that is you have a good chance on hitting that stop. So the investor might say, I'd rather under position size and set a wider stop so it has a lesser chance of hitting out. Now, if we kind of said, well, at what point would we say this trend is reversed? 314 is where the breakout was. 308 is the middle of the channel. And we're going to put that stop all the way down here below the 303. Why? Well, because we're not trying to get stomped out prematurely. We're only trying to get stomped out if that trend fails. Now, James, historically, did you ever set tight stops? Yeah. When the volatility went up, what did you notice? Exactly what I just told you. So the investor might say, I'm going to take the position, cut it in half, set wider stops, have lesser chance of getting stomped out. Because once you get stomped out, you locked in the loss. It's realized. Okay? 296.94. Going to come down here, 296.94. Okay, there it is. What about the target? What about the target? Yep, Jay Richardson says tobacco, okay, still doing well. I'm going to come to that, but I'm also going to come to some of the liquids as well. Now, let's go to that one next, and we'll bring it up. So now I need to know the target, okay? So when I look at this in terms of a position size, it'd be about 10 shares. So I'm going to just round this down, just go 10 shares. Now, I want to also tell you, do not fool yourself and think, oh, 10 shares, you can't make any money or lose any money. Yeah, you can, okay? You go up 30, 40 points or so, it starts to become more material, or it goes down 30, 40 points. It's like, wow, it's only 10 shares. Yeah, exactly. But it's a bigger dollar stock. Now, I'm going to go dated GTC there. And the target there, Jerry says, is 325. Can't do that trade for 325. When I go back and look at this and kind of say, what do we have here? I want to kind of go back and look at this old area, okay? Now, if I look at this prior top, this prior high, about right there, and I'm going to draw to where we had most of the touches. Most of the touches, okay, is probably going to be right in the ballpark of 332.29 if we're looking at a 161.8 fib. Some technicians, they like to use the 200% extension. Where does that come from? Well, if you like to trade channels, the 200% extension, which is not a fib number, okay, it's just taking the width of the channel and adding it on top. How do you get that? Mine doesn't have that. Mine doesn't either right now. But we can actually have a line drawn at 200. So if we said what's the most probable, if it were, probably 332. Jerry, we're a little bit higher, okay? David says 345. We're a little less. And notice the way we drew this. We drew this from the bottom where we got most of the touches. Now, if I went down and kind of scrolled this down and said, where is it? I got a 261. I'm going to right-click on that line. Right-click, edit properties, and I'm going to take the 261 out, and I'm going to type in 2.00. Okay? Now, when I do that, click OK, what do we got? We got 342.18. What is that? It's from support to resistance, width, dollar amount, add on top, doink, 342. Now, what I'm going to do is if there's a guy named Bill, and that investor, Bill, hypothetically, is going to try to sell at 342, you got to remember other investors are probably thinking the exact same thing potentially you are, okay? So let's say another investor, hypothetically named Bob, said, look, I'm going to try to sell before Bill can get a hold of that and try to sell at the higher target. Some investors will try to undercut, or they'll try to forecast where other investors might try to sell. The more sellers we run into, kind of the more radical the price changes we might have. That's why some investors like to shed maybe 1% less than the target-ish to try to sell before the mob potentially sells. Okay? Have you seen that? Just let me know. Confirm send. So we're going to add to this position in Mickey D's. Notice on this, on the stop, it says with stop orders, the activation price is the stop price. That's a trigger to sell. The execution price, what it actually fills at, we don't know what that's going to be because that stop is a market order. Okay, send. Now let's go back to just real quick also Mo. Now, we said when the market goes down, we kind of said that there can be sometimes, they call these the vice stocks. Okay, now how many of you have heard that before, the vice stocks? And when I say vice, now by the way, I'm not making fun of just smokers. Okay, I mean, I'd probably say, look, I like to drink a beverage. Okay, I'm not going to lie to you. Okay, I like to drink a little Fresca or a little DP, Coke Zero. I mean, a little something with bubbles in it. Okay, there's some people that like to do that with coffee or tea, right? There's a lot of us that have vices. Don't just look at the smokers. Okay, let's not kid ourselves. And Fairborn, he has his little beverage with last name Star at the end. Okay, some of you have the other one, Energy, whatever. Okay, now, you're going to notice that when you look at MO, we're going to go back to the trade tab. Now, by the way, this is interesting. We kind of brought this up. And who brought this up? I'm blaming you. No, I'm just joking. But if you look at this, it went up to the target and the paper money account sold it. And it sold down. Okay? So let's go back and look at this for just a second. It rallied up to the price target. I remember selling it. And it fell back down for 2 days. And let's kind of zoom in on this. Now, I want to go to one of the questions that was brought up, okay? And I just want to make sure that we have this. Let me bring it up where we have the hold dots on the chart right here, okay? And let me strip this Fibonacci's off so we can kind of see this for just a second. I want to also go back to kind of what we see on the bottom with the MACD and stochastics, okay? So first off, we sold that stock, I believe it was about right there, okay? We sold it at the prior high. The position that we had before was long shares with a protected put. Protected put went down, stock went up, we made the offset. Now, if you look at the MACD, what is it telling us? Well, on this MACD, we see that the MACD predominantly is staying above the zero line, the equator. There was only 2 days here where the MACD went down, and it went down for just a bit. Now, when we look at the stochastics, what we kind of notice is when we get these crosses, you're going to see that these crosses, that's higher than it was before. The blue line actually crossing back to the upside in that area, that's higher than it was before. What you're now going to notice is this stochastics is staying pretty elevated. What does that tell us? Sentiment is high. The MACD kind of telling us about momentum. And if you're not falling down below zero line, there's a pretty hot trend here. Okay? Now, if we kind of go to this very next, what you're going to notice is right here, the dots on the chart are showing what we call hold or to hold. Those dots will appear. So when we actually look at the red candles, let's label 1, 2. Which red candle is the lowest? It's the second down day. And if we're trading above that second down day, there, we'll get that green dot there. Now, I want to kind of point something out. Many of you kind of said, well, could we use this if we liked or we wanted to play bearish? Could we flip this dot-wise if we were looking for something downtrending? Yes. I'll show that to you in just 30 seconds. But if we go forward there, get a little bounce, there's the next day, and there's today. Now, we could have said, well, duh, why didn't we get on Friday? Okay? Why didn't we get in this morning when it gapped to the upside? So we're really kind of day 3 on this as well. Now, let me kind of show you something just real quick. Let's go back to what I said I'll show you. If we go right back to the test tube, you're going to see that here, what you're going to notice is 2 things that I want to kind of point out here, okay? Notice that it says, and I'll share this chart with you, hold and close below low of high day. Well, if you go over to that little settings right there, it's going to ask us Do you want to show Cahold? Yes. No, which by the way would be the green dot. Now, if we said, for example, show the bearish version, so Cahold would be a bullish bounce version. The close below the low of the high day is the bearish bounce down version. Notice that it says no. If we wanted to, which I'll pull up a chart in just a sec, and said, look, I'm looking to play a stock to the downside. I want to kind of see the bearish bounce to the downside. All you just have to do is activate that. Not too bad. Okay, so it's right there. Just sometimes we don't realize it's in the setting. The second thing I want to do is I want to go back to, this is kind of talk about timing for just a second. The whole label bubbles, this is really just showing when we talked about the timing. Now, I don't know about you, but sometimes our timing could be improved. This is going to count the number of days. So on this, now where was that? Right there. Let me kind of turn this on and show you what it's doing. Now it's going to, what we're not interested in looking historically at it. We're interested in looking at where it is now. So what it does is if the moving averages, it counts the number of days that the moving average has been green. G2 for green 2, green 3, green 4, green 5, 6, 7, 8, 9, 10, and so on. It's matching on what we see on the market watch. Okay? So when you look at the 10-hole column, you're going to see that it should be matching what's on there. Now remember, scripts are not guaranteed for accuracy or timing. Verify. But if we're trying to kind of time the entry, the investor is really maybe perhaps trying to get in the first 3 days. So if we looked at this and said, okay, hey, we're going to consider an entry on day 13, I mean, the food's been sitting out for a little bit. Doesn't mean the investor can't eat it, but it's been in a trend for a little bit. Okay. Now, what I want to do is I want to kind of bring this up and kind of going back to what we talked about. So if we did this trade, okay, and I think this is a very important point to make, on the current position now, this is what we have. And the margin account still has it, but we sold it in the paper money account. The IRA we did, okay? Now what I want to do is I want to go back to the IRA and I want to add that position in the IRA. Now don't be so concerned about margin in IRA, okay? But what I'm going to do is step one, I'm going to buy the shares of the stock. Click on that, buy the shares of the stock. Now, one thing is the investor's trying to do is the potential upside is secondary to protecting the capital. Now that's kind of backwards because someone's like, no, I'm just going for the upside. You're actually kind of should be thinking about the downside first. What's the risk? What's the position size? Okay. You got to think about like a banker, an investment broker, an investment banker, okay, or someone who's actually lending capital or investing capital, whatever you want to call it. And what's the chances of me getting the money back or a percentage of it back? If you just think about the upside, you're probably not looking at the downside maybe as much. Reconsider. We're going to single order. First triggers SEQ. And when we do that, it's just saying first do it in this order. First, buy the shares. Second, we're going to come down to the April expiration, 38 days remaining. Now, it's like supposed to be 60 here in Salt Lake today. I'm kind of excited about that. But the biggest actually thing is here, that spring is right around the corner. For some of you actually in some cold weather, it's coming, sun's coming your way. Now, what we're going to do in this case is we're going to buy the put. Now, why is the investor considering buying the put? Well, now, by the way, when we look at the put, we're talking about going 20 to 50 days expiration on a monthly option. Second, we're looking at a strike that has a delta between 30 to 40 as a starting point. Now, also notice is we're looking to see can we actually pay less than 2% of the current price of the stock. So we would take, if the investor bought the put for $1.25 and the stock was $59.50, the investor is concerned about how much the put is because the stock would need to go up by the value of the put to get to break even. The higher the put value is, the more the stock has to go up just to pay for the put, assuming it goes to zero. Now I'm going to do this with a little wrinkle here. Does the investor have to pick that strike? No, they don't have to. Let's show a little variation. Wonder if they want to come down here to the 55. What's the risk of the 55? Well, you still have a right to sell the shares at 55. It's just at a lower strike. Okay? Now, if the investor does this, they have the right to sell the shares at 55, but now they're paying about 59 cents or paying 57 cents. Now, 57 cents of a stock that's at 59, that's like what percent? Well, it's like 1%. So the stock would need to go up by 57 cents to break even, assuming the put goes to zero. Now, guys and gals, think about the people that buy stocks and set stops only. Well, they got stopped out a lot and they realized the losses. The difference here is if the stock goes below the strike price, it doesn't mean the investor is out. Okay. The con about the put, you got to pay for it. The con about the put is, well, it actually increases theoretically the break even on the stock. The pro is that it creates a defined risk and gives some time to see if the stock, if it were to go down, can it come back up and get above the strike? The investor is not trying to have the 55 put become worth something. They want the stock to go up. This is the downside protection. How many of you are realizing that you might consider those more lately? Okay. Remember, that's not an area to be weak in. Okay. Understand when the puts might make more sense. Confirm send. Now notice right here on our second trade, buying the shares, 100 of them, 59.49, buying the pet at 50 for 57 cents. Now, if we added those two numbers together, that one and that one, we need the stock to be at about 59.49 plus 57 cents. At expiration, we need that stock to be at 60.06 at expiration to break even. Anything above 60.06, positive, okay? So when the investor buys the put, they're typically going to hold them all the way to expiration, okay? And we'll talk about the Amazon trade again tomorrow, where that put has become, well, it's become extremely valuable, okay? And we'll talk about when the investor might decide to exit that, or I should say exercise as well. Send the order. Now, I'm going to come back to just real quick, what's another stock? Now, when I say Mo, what's probably another stock that would be related to Mo? Who's their competitors? Starts with a P, ends with an M. Just let me double check. So if we look at PM and say, what do we got here? Is Philip Morris showing that exact same type of trend? No, it's not. Red moving average lines, denied. Okay, now let's go back to another stock. So then we're kind of talking about the vice stocks, okay? So one of the vices, or let's just call it enjoyment beverages, Molson Coors, okay? Now, if we look at this, I'm not going to say it's the most perfect inverse head and shoulders we've ever seen in our life. No, most of them are not. And what you're now going to notice is it's kind of pushing right back up near that area of resistance. Now, if you go back up and look at this, we had on the right-hand side, the significance is this right here, that's a bull flag. And it's making a bull flag right into the area of resistance. And on Friday, insofar, it's actually had some decent volume. Now, it's a $63 stock. Now, for this $63 stock, what I'm going to do is I'm going to come back and kind of just take a look at, just quickly, volatility. Now, if the investor is going to buy shares of stock and buy the put, most of the time, more common than not, if we're going to get something that's not as expensive, the IV 40 or so days out needs to be 15 and 24. Why? Well, because when we go look for a put that has a delta of 30 to 40 or so, the ones that we can get as close as we could to that, we're just taking the option premium divided by the stock premium. OP, option premium. SP, stock price, I should say. Stock price. Now, if I said, you know, James, I don't mind the put, but I don't want to pay a lot for it. Well, you can say that, okay? But if you don't want to pay a whole more for it, you have a lower strike. What's the risk? Well, if we buy these shares at 63.56 and we buy the put at 60 for a defined risk, what's the max loss? Answer, 356. That's the stock risk. But if you also paid $1 or 95 cents for it, grand total is going to be $4.56. Okay? Total before commission. Where's the commission coming from? The commission is coming from not the shares. It's coming from buying the put option contract. Why is the investor talking about buying puts as downside protection? Because if we have this volatility, we don't want to set a stop and then just artificially be stomped out, only to see the stock go right back up again and have locked in losses. Now, one of the favorite columns as we kind of wrap it up here, if I go to this drop down right here, any of the drop downs, go to option theoreticals and Greeks and go right to probability of touching. This should be an eye-opening moment when you take a look at this. If we said, well, if the investor bought the shares of the stock and they set a stop at 60, probability-wise, what is the likelihood of the stock going to that price, 60, from now to expiration? Answer, a 55% chance, greater than half. So that means if you had 10 positions that were like this, 55% of your positions should probably be gone in 40 days. That's why it's so hard for a regular investor that doesn't know this to, seems like I'm always like building and starting over, building and starting over, and building and starting over. If they set stops even tighter, if they set the stop at 62 and a half, 10 positions, probably 85% of their positions will be gone at the end of 40 days. So setting stops is not necessarily always the answer, okay? How do you handle volatility without realizing max loss? Now, the way you realize max loss in this trade is the stock closes below the strike price. Now, I gave you a homework assignment last week to practice that. I still think it's still worth practicing that, okay? That doesn't mean that short put verticals could not be looked at, etc. But trades are strategies that have defined risk. When we talk about married puts, we're just talking about buying shares of the stock with buying a put at the same time. Now, I got to wrap this up, so let's kind of go back to this just real quick. When we go back to this trade, what I'm going to do is I'm going to click on that ask price, like we did before, single order, like we did before, first triggers execute. In other words, do it in this order, buy the shares first. Step two, for some of you said, James, I like to practice buying puts, but I don't want to pay a lot for them. Let's look at the pros and cons, which we just talked about. I'm going to click on that 60. Do we have to try to buy it at $1? No, we could try to go at 95 cents. Got to see if it's going to fill, though. And what I'm now going to do is I'm going to add to that position, maybe thinking that maybe the other Vice stock might get a little lift as well. So this will be our third trade here in closing. So I'm out of my time here today. We kind of talked about the current market. We talked about kind of the stochastics, the MACD. I will make sure that I post in the chat the chart as well, the setting that we actually had. Go out and practice this. I think it's important to understand that this is why there are different strategies. Sometimes the investor does not want higher delta strategies in more volatile times. And this is the perfect reason why to consider that. Now, thank you so much for your comments and your participation. I also want to say thanks to Michael Fairborn for answering those questions in chat. Also remember that I'll be back on tomorrow morning at 11 a.m. Eastern. And also remember that Michael Fairborn, you know him, he's a fellow instructor. He does a great job in his classes. Feel free to follow him and him on X as well. Remember, with what we discussed, it was done for example and illustrative purposes only. And stay tuned for Cameron May coming up next. And as we do that, remember, this has been the class of Trading with Technical Indicators. We'll talk back more about tomorrow at 11 a.m. Eastern. So join us. Take care. Bye-bye.